In 2009, the worst year of the worst financial crisis in a generation, the number of millionaires in the United States increased by 16%, not after the recovery, during the crash. While unemployment hit 10% and 4 million people lost their homes, 16% more Americans became millionaires. This is not a coincidence, it is a pattern, and it has repeated itself in every major recession in modern history. To understand why, you need to understand three forces that activate at the same moment. Every time an economy contracts, the first is asset prices. When markets crash, everything goes on sale. Stocks, real estate, businesses, private companies. The assets don't disappear, they just change hands. From people who need to sell to people who can afford to wait. A house worth $800,000 in 2006 was selling for $450,000 in 2009. Same house, same street, same neighborhood, different price, because the seller was desperate and the buyer wasn't. The second force is the cost of borrowing. Central banks slash interest rates in recessions. The cost of borrowing money drops at exactly the moment the assets are cheapest. For anyone with good credit and cash reserves, this is a double discount. Prices are down and financing is cheap simultaneously. That combination has never lasted long. But while it exists, it is one of the most powerful wealth creation windows in capitalism. The third force is competition. Recessions kill weak businesses and pause strong ones. The competitors who were crowding your market in 2007 are gone by 2010. The customer base is still there. The demand hasn't disappeared, but the competition has. The market share that was impossible to take in a boom because everyone was operating and growing becomes available almost overnight. Now the names. In 2008, Warren Buffett called Goldman Sachs and offered $5 billion. At the peak of the panic when most investors were pulling money out of everything. In exchange, he received preferred shares paying 10% annually, plus warrants to buy Goldman stock at a fixed price. By the time the crisis resolved, that single investment had returned roughly $3.5 billion in profit. Buffett didn't predict the crash. He had the cash ready and knew exactly what he would do when prices collapsed. John Paulson did predict it. In 2007, before the collapse, he quietly assembled a position that would pay out if the subprime mortgage market failed. Most of Wall Street thought he was wrong. When the market broke in 2008, Paulson's fund made $15 billion in a single year. His personal share was approximately $4 billion. It became known as the greatest trade ever made. Sam Walton didn't trade markets, he built stores. During the stagflation of the 1970s, when inflation was running at double digits and consumer confidence was collapsing, Walton expanded Walmart aggressively into markets that wealthier retailers were abandoning. Consumers who could no longer afford department stores needed somewhere to shop. Walton was there. By 1985, he was the richest person in America. Howard Schultz used the 2008 crisis differently. Instead of expanding, he contracted, deliberately. He closed 600 underperforming Starbucks locations, renegotiated leases on the ones that remained, and used the recession to rebuild the company's cost structure from the ground up. When the recovery came, Starbucks was leaner, cheaper to operate, and positioned for growth it couldn't have achieved in a boom. The stock multiplied 10 times between 2009 and 2015. 4 people, 4 different recessions, 4 entirely different strategies. What connects them is not genius, it is preparation. Every one of them had cash, credit, and a plan before the crash happened. The recession didn't make them rich, it gave them the opportunity. They had already done the work to be in a position to take it. Here's what the millionaire creation story leaves out. For every person who bought a house at the bottom of 2009, someone else lost that house. The asset didn't appear from nowhere, it transferred. From a family who couldn't make their mortgage payments to an investor who could. From someone with no margin left to someone with margin to spare. Between 2006 and 2014, institutional investors purchased approximately 200,000 single-family homes out of foreclosure in the United States. Many of those homes became rental properties. The families who lost them became tenants, often in the same neighborhoods, sometimes paying rent to the people who bought their crisis. Recessions don't destroy wealth, they redistribute it. And the direction of that redistribution is almost always the same, from people with thin margins to people with thick ones, from the over-leveraged to the under-leveraged, from the unprepared to the prepared. The wealth that gets created in a downturn doesn't come from the economy, it comes from other people. That is the part of counter-cyclical wealth creation that nobody puts in the headline. So what do you actually do with this? The frustrating answer is that counter-cyclical wealth creation isn't really about recessions. It's about what you do in the years before one. The people who got rich in 2009 weren't smarter than everyone else in 2009. They were more prepared in 2005, in 2006. In 2007, they built cash reserves when times were good and credit was easy. They paid down high-interest debt before they needed to protect their credit score. They thought clearly about what they would buy and at what price before the opportunity existed. They made the decisions in advance so that when the moment came, they didn't have to think. They just had to act. The recession is not the strategy. The recession is the exam. The preparation is the strategy. And preparation happens now. Not when the market is already falling and everyone around you is already panicking. 3 things. Before the next recession, not during it. Build a cash reserve, not just an emergency fund, but genuine dry powder. 6 months of expenses minimum, more if you can. The people who buy at the bottom are the people who weren't fully invested at the top. Reduce high-interest debt. Not because debt is always bad, but because in a recession, debt payments force sales. Every debt obligation you carry into a downturn is a constraint on your options at exactly the moment your options matter most. And decide now what you would buy at a 40% discount, a specific stock, a specific type of property, a business in your industry. The answer doesn't need to be perfect, but having an answer before the sale starts is the difference between moving quickly and standing frozen. Every recession in modern history has created a new generation of wealthy people and a larger generation of people who lost ground. Which side of that transfer you end up on has almost nothing to do with luck, and almost everything to do with what you did before the alarm went off.